Treasury yields are rising this morning as investors weigh Fed Chair Jerome Powell's concerns about the state of the economy and amid President Trump's tariff rollout. Powell warned of the challenging impacts of tariff uncertainty to the economy, but says the Fed is in a wait-and-see mode.
We are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks.
President Trump once again criticizing Powell, saying that the Fed is too late and should have already lowered interest rates. Is the Fed behind the ball? Joining us on set is Blake Gwinn, head of US Rates Strategy at RBC Capital Markets. Great to have you on set as always here, Blake, and good morning to you. So, is the Fed behind the eight ball, or is that more so political posturing from the administration right now amid what the markets are seeing as a self-induced hit to the economy right now?
Well, in which direction do you mean? Because we have risks in both sides. I mean, we could find out in 6 months that they're actually behind the curve on inflation, or we could find out that they're 6 months behind the curve on, downside risks. So I think that's the problem facing the Fed. I mean, the analogy that I've been kind of using with clients, it reminds me of a goalkeeper in soccer kind of defending against a penalty kick. You don't know which way the ball's going to go. It could go to the inflation side, upside inflation risk. It could go to the downside on labor, thinking about their dual mandate. So if you preemptively jump in one direction before you see where the ball's headed, maybe you guess the right direction and you save it, or you end up very offsides to try to save it in the other direction. So Powell just wants to see which way that ball's headed before they actually start to react.
I'll just note that you sent that graphic to our team here, and I think it's probably one of the first times that we've received a meme-type graphic from RBC, so we appreciate that as well here.
Yeah, we certainly do appreciate the references to Ferris Bueller, the goalie references, but I am curious, Blake, because you had updated your guidance to 3 rate cuts this year prior to Powell's commentary. I just asked you, has that changed since he spoke? You said no. How much damage do you anticipate happening to the economy to justify 3 cuts this year, given Powell's commentary about not being in a rush?
Yeah, and I think there's kind of 2 fronts that we've been thinking about this on. One is the actual impact from whatever tariffs end up being in place over the next 6 months to a year, right? So you have the actual drag that's coming from that. And if you look at that, there's huge amounts of uncertainty. We have no idea where it's going, but we have to make some kind of base case. And I think it's very, very clear that that base case is worse for us than it was 2 months ago. Even with the pause, I mean, we're looking at an effective tariff rate that's still the highest we've had in 100 years, right? So that's going to drag. I think the second piece, and I think Josh really hit on this very well, right, to focus on the uncertainty, there's the impact of the tariff itself, but then there's the uncertainty that this is causing. So even if you may not be directly impacted by a tariff that's in place right now, are you buying new equipment? Are you hiring new people? Are you leasing new land, expanding your business? Yeah. And I think that's toothpaste that's very hard to put back in the tube. You've rung that bell, the uncertainty is there, you've injected it into the psyche of C-suites and consumers.
Right.
It's very hard to unring that bell.
To that exact point, I want to talk about the Philadelphia Fed survey from this morning. This is obviously only one region, but some of the data in here really jarring. Prices paid soaring, employment way down from previous levels, new orders in the negative, way below previous levels as well. Again, obviously just one region, but to what extent is that an indication of data that could show up in the hard data that the Fed looks at sooner rather than later?
That is the question, and I think when Powell says he's wait and see, what we're waiting to see is if all of the negative sentiment that's been showing up everywhere, I mean, it's in all the consumer surveys, all the business surveys, for several months now have been showing that there's a huge amount of uncertainty on tariffs specifically, but even around some of the DOGE stuff, the cuts as well. The real question is, how is that going to cross over into the hard data? And I think that's a difficult question right now because we have had a period over the last few years where the soft data, the survey data, has not really matched up with the hard data. Yeah. And that has persisted for a while. So usually you would look at the soft data and say that's a leading indicator. If people are very down on the economy, they're going to behave in a way that ends up dragging on the hard data. But given that that didn't really happen very much over the last few years, I think it's right to be somewhat doubtful if that's going to happen. But that's what we're waiting to see, is the downside that has been very clear in the survey and the soft data. Is it going to cross over into the actual activity data? I think March is too early. It's not going to be in the March data. We need to wait until that April-May data to see that really starting to build.
And so how would what you're seeing in the data also then go and influence your modeling for rates right now and kind of over the next perhaps 3 to 6 months for investors out here who are trying to look out into the future and best figure out, okay, where that rate strategy should influence their investment decisions as well on the back end of that.
So the hard part about the rate outlook right now, too, is that you have a lot of uncertainty at, let's call it, a 1-month time horizon. I feel much more confident about a 3 to 6 month horizon, right?
Yeah.
Because there's just so much noise right now. There's a lot of volatility. There's a lot of positioning that's been shifting around that has caused some of the volatility we've seen over the last 2 weeks. So I feel very unsure about where things are headed over a 1 week, 2 week type of time frame. But I feel more confident that if we're talking kind of 3 to 6 months, that those downside risks, that crossover from the soft data to the hard data is going to happen, and that is going to start to pull yields lower. I also think that probably comes with a bit of curve steepening, because I think that's more in cuts being priced in the front end, whereas the back end, we still have some of these concerns around term premium, around supplies, deficit. You've heard rumors of foreigners selling assets. So I think that's probably going to keep the back end from kind of performing in the same way as the front end. So we get a little bit of that curve steepening. Yields come lower, but it is with a bit of a steeper curve.
Continuing on that, I'm curious your thoughts on the safe haven status of US Treasury bonds, especially in the context of President Trump posting about a potential termination of Fed Chair Jay Powell. Unclear if he was talking about when his term is up or a more immediate termination here. To what extent does a statement like that and also the policy uncertainty from Washington put the safe haven status of the U.S. at risk?
Yeah, I mean, the way I've been kind of talking about is the stability premium that we've enjoyed for a very long time is in question right now. But I've generally been a bit of a seller of this theme because it's tough to figure out where you go. I mean, there are network effects to owning treasuries. I mean, treasuries are still where the liquidity is. It's a very, very deep pool of assets. There's no other foreign sovereign bond market that could absorb the kind of flows the Treasury does. And it's very hard to move away from. I've actually been likening it to the move away from Twitter. I mean, multiple times we've heard people say, we're going to Blue Sky, we're going to Threads. It just never quite seems to happen because you get over there and realize that nobody else is over there. And so it's just very hard to pull away from treasuries in any large way. Now, I think over the next few years, that's going to be a theme that we watch very, very closely. And I do think on the margin, these long overweights that people have held in U.S. assets may start to level out a bit. Like I said, I'm a bit of a seller of that, but even marginal moves, if you have a global bond portfolio and you go from 40% U.S. Treasuries to 35%, if a lot of people do that, it could still be pretty meaningful. So definitely a theme we'll be watching.
Blake, great to see you this morning. Thanks so much for taking the time here with us on set.